You think you understand how money works. You really do. You've read the articles, you've watched the charts. You nod along when someone says fundamentals matter. Cute. That's not an anomaly, that's the system you trust with your retirement account. And you probably clapped when it happened. Because somewhere in your brain, a little voice whispered this time it's different. Spoiler, that voice has a perfect track record of being wrong. November 30th, 2022. Nobody important was paying attention. Engineers sipping cold brew, debugging code, a regular Wednesday. Then a chatbot dropped, and within 48 hours, people were using it to write breakup texts and explain quantum physics through Minecraft. Your kid probably told you about it before your financial advisor did. 1 million users in 5 days, 100 million in 2 months. Instagram needed 2.5 years for that. Facebook needed 4.5. This thing did it in 60 days. And here's where your I understand markets confidence should have died. Google, the company that literally invented the technology behind all of this, sat on it. For years, too scared of lawsuits, too scared of bad press. They had the transformer model, the research paper had their names on it. Didn't matter, someone else shipped first. And in tech, first mover advantage is everything. So Google Panic launched their version. It hallucinated in the first demo on camera. Microsoft threw $10 billion at the chatbot company. $3 billion more on standby. Amazon started dumping billions into a competitor. Random startups slapped AI onto dog-walking apps. Cool chatbot to $7 trillion gamble, 24 months. And the people writing those checks, the ones you assume are smarter than you, the ones whose confidence makes you feel safe, they might be walking into the rudest awakening since 2008. But you already knew that, right? Because you understand how money works. So let's do the math. The kind of math that makes venture capitalists sweat through their Patagonia vests. OpenAI charges you $200 a month for a pro subscription. Sounds like a lot, sounds like a money printer. Except Sam Altman himself admitted they lose money on every single subscriber. Not break even, not slim margins, negative. Every person who hands over $200 is actually costing the company more. More than that, just to keep the servers humming. Imagine running a lemonade stand where every cup you sell puts you deeper in debt. And then someone values your stand at $500 billion, that's where we are. Now rewind to why one top-tier H100 GPU rents for $3 an hour. Cute number, harmless, but no startup trains a model on one chip. A small team, nothing fancy, just trying to get one model off the ground, rents a 500 chip cluster, that's $1,500 an hour. $36,000 a day, over $1.1 million a month. Just rent, not salaries, not office space, not the kombucha fridge, just the electricity bill for thinking. And they couldn't even get the chips. Nvidia had a 12-month wait list. Black markets popped up, people literally smuggling GPU shipments across borders. Like they were moving contraband. Jensen Huang started dressing like a rock star at conferences. Because, functionally, he was one. The man controlled the only resource every AI company on Earth was desperate for. Meanwhile, companies with zero revenue, no product, just a team and a pitch deck mentioning large language models. They were raising $100 million rounds. One outfit pulled $30 million to build an AI that summarizes other AI outputs. An AI for AI recursion as a business model. So here's your equation. The chips cost a fortune. The training costs a fortune. The inference costs a fortune. The subscriptions don't cover it. The revenue doesn't exist for half these companies. And the total bet across the industry just crossed $7 trillion. In 24 months, every single number in that chain is underwater. And then somebody finally asked the question. And the pricing, oh, the pricing is beautiful. OpenAI tested two numbers, $20, $42. Picked whichever one people complained about less. No cost modeling, no unit economics, just vibes. A $500 billion company priced its flagship product, the way you'd price lemonade at a yard sale. Because the subscription was never the business. You were never supposed to be profitable, you were supposed to be volume. Engagement metrics on a pitch deck. Proof of adoption so the real infrastructure money keeps flowing upward. Now here's the part that should make your stomach turn. To justify what's already been spent. This industry needs $2 trillion in annual revenue by 2030. Current revenue across the entire sector sits around $200 billion. That's a 10 times gap, not a stretch goal, a fantasy. And when someone inside the room finally asked the obvious question, when do we actually become profitable? The answer was a growth curve so vertical. It looked like it was drawn by someone who'd never seen a graph before. 100 billion by 2029. 115 billion in cash burn just to attempt it. So who's really on the hook? Not the founders, not the board members. They own equity in the infrastructure, they own the shovels. You own a subscription that loses money every time you use it. The more you engage, the deeper their loss. And somehow the higher their valuation climbs. Because the valuation was never about you turning a profit for them. It was about the asset underneath. The trillion-dollar scaffolding that somebody eventually will have to pay for. And if you're wondering who that somebody is, you're probably already looking at them. Private investors dumped hundreds of billions into AI startups since 2021. Most of it funneled into 10 companies, just 10. Their combined valuations ballooned by nearly $1 trillion. Because everyone figured one of them would become the next Google. Then the hallucinations started. ChatGPT invented legal cases that never happened, cited research papers from some parallel universe. Google's AI told people to glue cheese onto pizza. Because it scraped a Reddit joke and thought that was wisdom. The lawsuits came next. Artists, writers, musicians, journalists, all asking the exact same thing. Did you train on my work without asking? The answer, every single time, was a mumbled yes. Dressed up in corporate language about publicly available data. By mid-2024, the vibe shifted from gold rush to nervous laughter. At a dinner party where someone just knocked over the candles. Doubt, not panic. And doubt is worse because it lingers. So here's your one move, not a strategy, not a philosophy. A 5-minute task you do this Sunday. Open whatever app holds your biggest investment account. Find the holdings breakdown. Search for the top 10 AI exposed names, NVIDIA, Microsoft, Alphabet, Meta. Write down what % of your money is sitting inside those positions. That's it, you're not selling anything, you're not panicking. You're just reading a number you have probably never read before. Because the people inflating this bubble have the biggest wallets on the planet. They can keep it floating longer than your retirement timeline can survive a correction. The dot-com crash didn't destroy people who knew their exposure. It destroyed the ones who never once looked. One number, 5 minutes, that's the entire ask. Because when somebody on an earnings call finally says the math doesn't work anymore, you don't want to be the person discovering your exposure for the first time, while the ticker is already red. And that uncomfortable question buzzing in everyone's skull like a mosquito at 3 a.m. The one about when this whole thing actually detonates. That answer depends entirely on who blinks first. So here's the part where most videos tell you to buy the dip. Load up on NVIDIA, bet your rent money on the next OpenAI competitor. Before it IPOs, but I'm not going to do that. Because the honest answer is way less exciting and way more useful. You're watching a poker table where every player has $1 billion stack and zero intention of folding. That's their game, not yours. You don't have unlimited chips. You have a checking account, maybe a 401k, maybe some savings. You'd rather not watch evaporate like it's 2008 again. So the first thing you do is stop pretending you're sitting at that table. You're not, you're standing by the door. And standing by the door is the smartest position. In a room full of people who refuse to leave. Here's your survival buffer. 1. If you own individual AI stocks. Know your exit number, not a dream number, a real one. The price where you walk away and sleep fine. Write it down, tape it to your monitor. Because when the earnings call hits and the stock drops 14%, in after-hours trading, your brain will tell you to hold. Your brain is wrong. The number on that sticky note is right. 2. Keep 6 months of expenses in something so boring it makes you yawn. A high-yield savings account, treasury bills, whatever lets you survive a correction without panic selling your portfolio at the bottom. That's not investing advice, that's a seatbelt. 3. If your entire retirement is riding on tech, rebalance. Not because tech is doomed, but because concentration is how regular people get destroyed. In every single bubble since tulips. Spread it out, make it boring. Boring is how you're still standing when the music stops. I'm not telling you AI is worthless. I'm not telling you to short the market. I'm telling you that every bubble in history rewarded the people who stayed calm and punished the ones who thought they were special. The dot-com crash didn't wipe out the internet. It wiped out the people who confused momentum for strategy. Right now, the bubble floats, the big players keep raising, the chips keep stacking. And somewhere, quietly, the thing that breaks it all is already forming. A rate hike, a failed earnings call, a scandal nobody saw coming. You don't need to predict which one. You just need to not be standing under it when it falls. So that's your move, small, boring, unsexy. Set your exit number.